Hi, I'm Ross from Coombe Smith Property Accountants, and I'm just going to go through 5 simple ways either to reduce your tax or improve your cash flow. So these are pretty much things that apply to all property investors and just little things that you can do, to improve your numbers and work it better. So number one is if you've got a new property, especially if it's a commercial property, you've bought a residential property that's got a good level of chattels, it's really worthwhile getting value it in and getting a chattels appraisal done. So they value the carpets, the curtains, the dishwasher, the stove, the heat pump, the fences, the decks, the driveways, the paths, all the different items. And you can see some of those flashing in front of your screen that, first year's claim $10,000 or 12,600, older residential 5,900. So generally a residential costs about $500. Easily within the first year, you can get a couple of $1,000s of benefit and reduced tax. So really worthwhile looking at, if you've purchased a rental, a commercial or residential within the year, look at getting a chattels valuation done. It's the number one easy way to save tax. And it's amazing how many people are not doing that. Only firm we recommend is Value It. So that's number one, chattels valuation. Number two, if you're floating, you're generally paying a higher interest rate. So if you have a floating mortgage, look, can you fix it? Can you fix for 6 months or 12 months, or it might be longer than that? Rather than paying the floating loan, like we see people who've got $400,000 or $500,000 floating, you're probably paying a percentage more on that. So 500,000 percentage more, that would be $5,000 extra a year you're paying or costing. So to improve your cash flow, look, can you go from floating to fixed? If you've got a new build and you've got Back My Build or Blueprint to Build, I think it is ANZ or ASB, just have a look. Like in the past, those interest rates were awesome. They were a couple of percent below fantastic rates, but they're floating. So think about what's going to happen over the next couple of years. Is it better to fix them now, lose that new build rate, and then go to a fixed rate, or is it better to leave it floating? But definitely go through that thought pattern. Look at what the rates are, have a think about what you think is going to happen, and it could be worthwhile fixing those as well. So point two, generally don't have too much on floating, and if you do have a large amount, look at fixing. Unless you're really looking at paying off, but then in most cases you can probably still go for 6 months. Point three, so I'll get rid of my value it. Point three is structure. See if you can structure things better. So if you go onto our Linktree, and I'll put it in the comments later on. There's a whole lot of webinars that you can watch. There's also a whole lot of videos. So down further, there's a video on a smart structure that can save you thousands. This gives an example, of how we can structure things to save a whole lot of tax and potential things we can do. So really important that you've thought about your structure. Is it the best, and can you review it? In some cases, it's completely impossible for us to change it and a complete nightmare to change it. In others, it's really simple, it's really easy, and we can save literally thousands in tax. So things like, if the higher income earner owns the rentals or owns all the shares in the LTC and getting all the profit, we want to change that, we want to fix it. If you can't access the losses, we want to try and change that or fix it. So worth watching that video. Can a smart structure save you thousands in tax? I think that example shows over $10,000 in saving per year for that family. So definitely worth looking at that and thinking about your structure, just making sure you reviewed it. Obviously, if you can pay less tax, that's going to help you in the long run. Next thing we're looking at is interest deductions. Couple of things. Amazing. The first one, amazing how many people do not claim the interest during their build. So that's a huge deduction that's often missed. So many accountants or so many so-called property accountants are missing it, and missing claiming that interest deduction while you're building. So definitely think about that. If you're doing a new build, yeah, we can claim the interest while you're building. So make sure you do that. The second one is often we can move debt to where it is deductible. So obviously on residential properties, you buy an existing residential property now that doesn't have some sort of exemption to get interest, you're going to have no interest deduction because it's past 1st of October 21. So can we move that debt legitimately to a business, to a farm, to commercial properties, to buy shares? There's so many different ways that we can move around that debt. So yeah, if you've got some other assets and some residential debt that's starting to lose deductions, looking at can we juggle that debt round to make it deductible. Just be careful that if you go to commercial, sometimes the bank then goes, oh, it's going to be a percentage or two more. So just be careful about that. But my fourth point is, improving interest deductions, either making sure you claim what you're entitled to, like the new build part, or moving it to where it's more deductible. And my fifth item to reduce tax or improve cash is really simple: claim everything. So if you're traveling, keep a record of your travel for your rental properties. We can claim travel either the AA rate or the IRD rates. It might be a small deduction, but it's just reducing your profit, reducing your tax. The other one that a lot of people do wrong is they miss expenses. So this gets paid on my credit card. I buy a new letterbox, that goes on my credit card. At the end of the year, it gets forgotten. So one of the easiest ways to make sure you claim more expenses is have a bank account solely for the rental properties or that for that entity, and make sure everything gets paid through it. Have an EFTPOS card that pays for the letterbox, it pays for the little things. Everything goes through that bank account, and it makes it a lot harder to miss expenses. So hopefully you've enjoyed those 5 things and they help you. So they were Chettle's valuations, floating loans, reviewing structure, interest deductions, and claim everything. That's sort of 5 simple things, 5 things that are often missed that can improve your cash flow or reduce your tax. So and if you haven't, make sure you have a look on our Linktree. It's got so much good information on there. Like I say, webinars coming up, holiday homes, current deals coming up tomorrow night, and doing a relocated and a mortgagee sale, rental basics that I did at the end of last month, other webinars, lots of cool videos about cash flow, about saving on structures. Is your personal house a good rental? And it's also got how to contact us. Next step, having a free chat if you wanted to. So hopefully you've got some great information out of that, and hopefully you have a good Christmas. Thank you. Bye.